Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Figma.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators. VIP indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
So today we're cutting through this massive panic surrounding artificial intelligence disruption to really answer one vital question.
Right, because the fear out there right now is just palpable.
It really is. I mean, we're looking at a company that practically owns the digital design space, yet its stock has suffered this catastrophic 83% crash.
Yeah, 83% is brutal.
It's massive. So the mission for today's deep dive is to figure out if this brutal sell-off is, a glaring warning sign to stay away, or if it's the generational buying opportunity of the decade.
Exactly. We really need to look past the fear and figure out how this business actually functions at its core.
All right, let's move into the wealth building context.
So when you think about building long-term wealth in the tech sector, you're constantly hunting for that incredibly rare moment.
The moment when a tool becomes infrastructure.
Exactly. When it transitions from being just a convenient software application to becoming absolute indispensable infrastructure, we need to completely reframe how we view Figma today.
Because most people just see it as like a drawing app, right?
Yeah, exactly. If you think of it just as a digital app where graphic designers draw buttons and pick colors, you are completely missing the bigger picture. It has essentially become the central nervous system for modern product teams globally.
And a central nervous system is, well, it's incredibly difficult to extract once a company's built around it. I mean, you're looking at the sheer scale of their market penetration to really build that infrastructure argument.
Spot on. I mean, the raw user numbers are just staggering. They currently boast over 13 million users.
Wow.
Yeah, but the wealth-building narrative really crystallizes when you zoom in on the enterprise level. We are talking about 95% of Fortune 500 companies actively using this platform.
Which is almost total market capture at the top tier.
It is. And think about what that actually means mechanically for those businesses. You have a highly sticky, collaborative environment. Once an entire product team, the designers creating the visuals, the developers writing the code, the project managers tracking the progress, once they embed their daily routine into a single shared file, ripping that system out becomes a logistical nightmare.
Right, because it's not like just swapping out a paintbrush.
Exactly. It's like trying to replace the plumbing while the building is fully occupied. That level of entanglement creates a really solid foundational pillar for a long-term tech portfolio.
I mean, I definitely get the infrastructure argument, but from a risk-aware perspective, we have to look at the reality of the broader tech landscape right now.
You mean AI threat?
Yeah, exactly. Like, is this truly an unshakable operating system, or is it an incredibly specialized tool that is right in the crosshairs of the current artificial intelligence revolution?
That is the big question.
Because if an AI can just generate a perfect user interface with a single text prompt, suddenly you don't need a massive team of human designers collaborating in real time.
Right.
So for you as an investor analyzing your portfolio, that is the core tension here. You have to figure out if you are buying a top-tier asset on a temporary discount or buying into a business model that is about to be rendered completely obsolete by automation.
And that tension is exactly what is driving the massive volatility we are seeing right now. The market is incredibly fearful of that exact disruption scenario playing out.
It's pure panic in some of these tech names.
It really is. But having a great product doesn't automatically mean the business is healthy, and vice versa. We need to look under the hood to see how they are actually monetizing that user base, because the raw numbers tell a completely different story from the panic we're seeing in the headlines. Now let's look at the fundamentals, because when you tune out the noise and just look at the financial health, the metrics here are exceptionally elite.
Okay, let's hear the numbers.
Let's start with the top line. For fiscal year 2025, they generated $1.056 billion in revenue. That is a 41% year-over-year increase.
Breaking $1 billion while growing at 41%. That's huge.
It is. What's even more impressive is that their international revenue is growing even faster, up 45%. Hitting $1 billion in revenue while still growing at north of 40% is incredibly rare in the software sector today.
The top-line momentum is definitely undeniable.
Right.
I mean, the fourth quarter numbers were very strong, too, coming in up to $304 million and comfortably beating estimates.
Yeah, they crushed it.
But as a practical investor, looking at long-term viability, if you look further down the income statement, it reveals some glaring red flags.
You were talking about the GAAP losses.
Yeah, you have a GAAP net loss of $1.25 billion.
Okay.
On paper, according to standard accounting rules, that looks terrifying. That looks like the company is just hemorrhaging cash.
It does look bad on the surface, yeah.
And perhaps more concerning from an operational standpoint, management has explicitly guided that their operating margins are going to compress dramatically. They're dropping down to a mere 7 to 8% in 2026. How exactly is a shrinking profit margin a good thing for long-term wealth creation?
I know it looks alarming at first glance, but context is everything here. First, let's unpack that $1.25 billion GAAP net loss. The vast majority of that figure is driven by one-time IPO-related equity compensation costs. It is an accounting reality. Essentially, they're paying early employees with stock.
Right, so it's a paper loss, not cash going out the door.
Exactly. It's not a reflection of actual cash bleeding out of the core business operations. If you look at their actual cash generation, it is incredibly robust. They generated $238.3 million in trailing 12-month free cash flow. They are actually printing money.
Okay, so the actual cash flow definitely mitigates the panic around that massive net loss.
Right.
But what about that margin compression?
The drop to 7 or 8%?
Yeah, dropping operating margins down to 7 or 8% when they were previously operating at double those levels, that is a massive contraction.
It is a massive contraction, but it is a deliberate strategic weapon, not a structural failure. They are aggressively taking that generated cash and reinvesting it into building out massive AI infrastructure.
So they're spending heavily to stay ahead of the curve.
Exactly. They are self-funding a total pivot to ensure they control the next era of design. And because their gross margins, the profit they make before operating expenses, are a spectacular 86 to 88%, they have a massive cushion to absorb this aggressive investment phase.
I see.
They are choosing to make less profit today to build an unassailable moat for tomorrow. And forward-looking models suggest a very credible path for those operating margins to rebound to 9.7% by 2028 once their AI monetization really scales up.
Okay, so they are willingly taking a short-term hit to profitability to build out features that will theoretically protect them from the exact AI disruption the market is so terrified of.
Precisely. And they have a fortress balance sheet that allows them to play this long game. They're sitting on roughly $1.7 billion in cash.
That's a massive safety net.
It really is. Plus, they boast a Rule of 40 score of 53%.
For those who may not know, the Rule of 40 is key for software. Right.
Yeah. If you are evaluating software companies, you always want to look at the Rule of 40. You simply add the company's revenue growth rate to its free cash flow margin. Anything over 40 is considered elite, meaning the company is perfectly balancing rapid growth with actual profitability.
And Figma is sitting at 53.
Exactly. That means they can fund this massive AI transition internally without ever having to dilute you, the shareholder, with secondary stock offerings, and without having to take on toxic, high-cost debt in this elevated interest rate environment.
Having a $1.7 billion cash hoard definitely gives a management team the breathing room to make expensive strategic pivots.
Absolutely.
But an aggressive reinvestment strategy only matters if it actually results in a product that enterprise customers are willing to pay for. We need to see proof that this pivot is working. That brings us to the catalyst timeline.
And the timeline to prove this thesis is incredibly compressed right now. The absolute most critical event on the calendar is their Q1 2026 earnings call, which is scheduled for May 14th, 2026.
That's coming up fast.
Yeah, the entire market is essentially holding its breath for this single data point.
Because the expectations going into that call are heavily skewed, right? Management has already guided for 38% revenue growth in Q1, which beat prior analyst estimates by a solid margin.
Right, the baseline growth is there.
But frankly, the baseline revenue numbers almost feel secondary to the narrative right now. On that May 14th call, institutional analysts are going to demand absolute clarity on how AI competitors are actively impacting the sales cycle. They want to know if clients are hesitating to renew.
Exactly. Management doesn't just need to play defense on that call. They need to show their offense. They have been rolling out their own massive AI integrations, specifically tools called Figma Weave and Figma Make.
Which sound pretty ambitious.
They are. And the market desperately needs to see the adoption metrics for these new features. We are currently entering the major conference season for software and design. Any hard case studies or adoption numbers showing that massive enterprise clients are actually using, and more importantly, paying a premium for these new AI features will be a massive validation.
It proves they aren't the ones being disrupted.
Right. It proves they are the ones doing the disrupting.
There's also a broader macroeconomic component here that heavily influences how these catalysts will be received by the market.
Oh, definitely. The whole software space has been a mess.
Yeah, the entire software sector has been reeling lately. We've seen really cautious outlooks from legacy giants like IBM and ServiceNow, which has cast a dark cloud over anything trading at a premium software multiple.
It's that whole syspocalypse narrative.
Exactly, where enterprise spending is supposedly freezing up across the board. But that extreme pessimism means the sector is heavily shorted right now. If we see a macro pivot, for example, clear central bank signaling on rate cuts, or fresh data showing that enterprise software spending is finally stabilizing, that acts as a massive sector-wide tailwind.
It would be a huge relief rally.
Yeah, battered, high-growth names that have been completely sold off would disproportionately benefit from that kind of macro relief.
For sure.
But all of these future promises and macroeconomic tailwinds really have to reckon with the absolute wreckage we are seeing right now on the pricing front. Now let's pivot to the chart, because to call this recent price action a mere repricing is entirely missing the severity of the situation.
Repricing is putting it mildly.
Yeah, the stock has suffered a brutal 83% drawdown. We're talking about a spectacular fall from a 52-week high of $143 all the way down to the $19 to $21 range.
It's wild to even look at.
When a stock loses over 80% of its value, that is not a standard market correction. That is a complete capitulation of the previous valuation model. It is a washout phase where fear takes over entirely, and investors are systematically dumping their shares regardless of the underlying fundamentals.
It is an absolute devastation of the share price. There is no denying that. But as an investor looking for asymmetrical opportunities, that specific level of devastation is exactly where you start looking for structural reversals.
Because everything bad is already priced in.
Exactly. It's like a controlled forest fire that burns away all the speculative underbrush. And we are finally seeing structural cracks in that long downtrend. Just recently, the stock staged a violent 8.3 to 8.8% single-week surge.
That's a massive move for 1 week.
It is. That kind of sudden, impulsive price action directly challenges the prevailing downward momentum.
But the crucial question is whether that surge is just a temporary bounce in a dying asset, a dead cat bounce, or if it's the beginning of a true reversal.
Well, the mechanics of that bounce imply a psychological capitulation bottom. Think about what an 83% drop actually means in practice.
It means everyone who wanted out is out.
Exactly. It means that every single weekend, every single investor who is remotely terrified of AI disruption has already hit the sell button and exited the stock. The selling pressure literally exhausts itself because there's no one left who wants to sell.
That makes sense.
When a stock drops 7% on competitive fear, but then violently rallies nearly 9% on a minor guidance beat, it tells you that the market has fully priced in the absolute worst-case scenario.
Goes coiled up.
Yeah, the stock is now acting like a tightly coiled spring.
Yeah.
Because all the sellers are gone, it becomes hypersensitive to any positive data point.
I understand the mechanics of seller exhaustion, but a stock doesn't rally nearly 9% just because people stop selling. I mean, someone has to actively step in and buy those shares in the $20 range.
Right, there has to be buying pressure.
Exactly. And the headlines are constantly telling us that artificial intelligence is going to wipe out human designers. So who is actually providing that buying pressure? So what does market sentiment look like? If you casually browse the financial news, the prevailing mood is completely apocalyptic.
It's doom and gloom everywhere.
Yeah, you are seeing a wave of bearish downgrades from analysts, specifically citing seat churn risk. Essentially, the fear is that if AI is doing the heavy lifting, companies will buy fewer licenses for human employees.
Which is a valid concern on the surface.
It is. And the primary catalyst driving this fear is Anthropic's new Claude design platform. Add to that competitive threat some very real corporate governance red flags.
Right, the board changes.
Yeah, Mike Krieger, the highly respected co-founder of Instagram, abruptly resigned from Figma's board in April. Alongside that, we've seen several senior executives systematically disposing of their shares. That kind of insider selling flow just does not inspire retail confidence when a stock is hovering near its all-time lows.
No, it doesn't. If you only read the retail headlines, it sounds absolutely terrifying. But if you want to understand the real trajectory, you have to look past the news flow and follow the smart money.
What's the smart money doing?
The institutional flow is quietly turning incredibly bullish. In the IT sector right now, we are seeing significant institutional block trades, essentially massive coordinated buys that indicate deep-pocketed funds are quietly accumulating heavy positions at these depressed prices.
Really, in Figma specifically.
Yes, specifically for this company. Hedge fund ownership actually increased from 38 funds to 51 funds at the end of the fourth quarter.
Wow, that's a huge jump.
It's a massive jump in institutional sponsorship happening at the exact same moment the retail crowd is panicking and selling.
And, when a massive tech company drops 83% and institutional money starts sniffing around, you inevitably get a swirl of speculative buyout rumors.
Exactly. And the chatter is getting very loud. David Stacks recently highlighted a broader market trend where massive private equity firms are using debt-fueled buyouts to take depressed software companies private.
Which makes perfect sense for a cash cow like this.
Think about the math here. If Figma's valuation stays compressed in this $20 range while they are organically generating over $200 million in free cash flow, they become a prime target for a private equity buyout.
And what about the regulatory stuff?
Right. We're also seeing some regulatory noise regarding an IPO probe by the law firm Lowy Dannenberg.
That sounds bad.
While that sounds intimidating on the surface, it's fairly standard behavior after a massive stock drop as firms look for litigation angles. But it certainly adds to the high volatility sentiment swirl.
Speculative buyouts and hedge fund positioning are fascinating to watch, for sure. But rumors and smart money flow do not magically protect a company from real fundamental threats to its underlying business model.
That's true.
If the core product loses its relevance, all that institutional money will evaporate. Now let's talk about the risks. The bear case here is not just some abstract futuristic fear. It is a direct structural threat to Figma's absolute best metric, which is their 136% net dollar retention rate.
Which is an incredible number.
For you as an investor, that number is the holy grail. It means that even before adding a single new client, their existing customers are spending 36% more this year than they did last year.
Right.
But tools like Anthropic's Claude Design are directly targeting that specific user interface workflow. Let's unpack the mechanics of that threat. Right now, companies pay Figma per seat, meaning per human designer.
The traditional SaaS model.
Exactly. If AI allows a marketing team to generate a full website layout with a simple text prompt instead of hiring 3 junior designers, the need for those 3 manual design seats just evaporates.
And the revenue goes with it.
Right. If those seats shrink, that 136% retention rate will completely collapse. Furthermore, analysts have rightly pointed out that Figma is lagging heavily behind its software peers in transitioning from the traditional seat-based subscription model to a consumption-based pricing model.
Yeah, the consumption model is key right now.
Think of consumption pricing like a utility bill. You pay for the computing power you actually use, rather than a flat fee per person. In an era of widespread tech layoffs, being slow to adapt your pricing model to match how teams actually use AI is a massive execution risk.
Those are incredibly valid structural risks, and the transition away from seat-based pricing is definitely a tightrope walk. But again, as investors, we have to evaluate what is already priced into the stock.
Right, back to the 83% drop.
An 83% collapse means the market is already assuming that catastrophic seat churn is a 100% guaranteed reality. But the nuance is in how the product is actually used by professionals. Claude Design is an incredible leap forward in technology, but right now it operates like a really fast, highly intelligent paintbrush. It appeals primarily to non-professionals, solo developers, or hobbyists trying to spit up a quick visual concept. What it entirely lacks is the deep, multiplayer, collaborative architecture that professional enterprise teams require to actually build a functioning product.
So the argument is that a text-to-image generator, no matter how good it is, just doesn't replace the need for a shared architectural workspace.
Precisely. Figma isn't just the canvas where the image lives, it's the entire studio. It is where the back-end engineering team, the front-end product managers, and the visual designers argue over spacing, compliance, and implementation in real time.
And you can't really prompt engineer that kind of collaboration.
Exactly. Single-player AI tools cannot replicate that complex enterprise ecosystem yet. Furthermore, to address the pricing risk, they are currently introducing a hybrid model.
Oh, how does that work?
You still pay for the base collaborative seats, but you also buy AI usage credits for their internal generative tools. And because they have that $1.7 billion cash hoard, they have an incredibly long runway to survive this awkward transition period. They can afford to carefully iterate their pricing model to find the perfect balance, protecting their core enterprise user base without facing any near-term solvency panic.
So it essentially becomes a race. Can Figma integrate AI into their massive collaborative ecosystem faster than the lean AI native startups can build complex collaborative features in their generators?
That is the exact race they are running right now.
So with everything on the table, what's the final verdict?
When you synthesize all the fundamental data against the technical devastation, the final investment view yields a bullish score of 7 out of 10.
A 7 out of 10. Okay.
Yeah. The core thesis is this. The stock has been aggressively penalized by an 83% sell-off based on the sheer terror that AI tools will imminently displace their workflow. However, the hard financial reality is 41% revenue growth, a 136% net dollar retention rate, and a massive $1.7 billion cash war chest prove that professional enterprise design teams remain firmly locked into this ecosystem. The moat is currently holding.
And the decision to dramatically shrink their own profit margins to 7%, that's still a smart move in this view.
It is the exact right strategic move. By deliberately compressing their short-term margins to aggressively fund their own AI integrations, management is proactively transitioning the platform from a simple design utility into an AI-first control layer.
They're going on the offensive.
Exactly. They are not waiting around to be disrupted. They are actively funding their own evolution. Because of this aggressive posture and their elite cash generation, the stock is uniquely positioned for significant re-rating upward once the upcoming earnings validate that their enterprise user base is actually adopting these new tools.
So what is the actual time horizon for an investor who wants to step into this kind of intense volatility?
This is not a quick flip. It requires conviction and patience. It is firmly a multi-year hold, specifically looking at a 2.5 to 3-year horizon. Based on the valuation models, as their profit margins eventually re-expand in 2028 and the new AI monetization truly begins to compound, we are projecting a 70.5% upside realized over that 2.6-year time frame.
That's a very specific and compelling projection.
It is. The ultimate question you have to ask yourself isn't whether AI is going to completely change the design industry, because it absolutely will.
Right.
The question is whether you want to own the company that already owns the entire global network of designers while that monumental shift happens.
That's a great point. And, it leaves you wondering, if AI eventually turns all of design into just code and text prompts, does the visual canvas even matter anymore? Or does the platform that manages the workflow become the only thing of value? Something to think about. And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $110K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.